Are you facing difficulty understanding the concept of debits and credits in accounting? If the answer is yes, worry not, because you are not the only one. ADELER is your ticket to understand the debits versus credits concept and remember it better. Memorizing is good, but understanding is always better. Our starting point will be determining the normal balance of an account. DC, ADELER, helps, debits on the left, credits on the right. ADE, assets, dividends, expenses, are debits on the left. LER, liabilities, equity, revenue is on the credit side, the right. Some use drawings instead of dividends. Debits and credits are core to accounting. To grasp DC, ADELER, let us take it step by step, starting with half the terms and understanding the accounting equation first, shall we? Assets equals liabilities plus equity, also known as the balance sheet equation. Assets represent what a company owns. They increase with debits and decrease with credits, as their normal balance is debit. Let's look at an example. Inventory, representing goods held for sale, is an asset account with a starting debit balance of $200. During the period, receiving inventory worth $70 increases the debit balance, while shipping goods worth $50 decreases it via a credit. At period end, the opening balance of $200 debit plus $70 debit for receipts minus $50 credit for shipments results in a new balance of $220 debit. Liabilities represent what a company owes. Their normal balance is credit. Liabilities increase with credits and decrease with debits. Accounts payable, a liabilities account, tracks unpaid supplier invoices and starts with a credit balance of $300. Receiving new invoices for $70 increases the credit balance, while paying $120 reduces it via a debit. At period end, the opening balance of $300 credit plus $70 credit for new invoices minus $120 debit for payments results in a new balance of $250 credit. Let's connect the examples by examining debits and credits. Both mention the number 70. The company received inventory worth $70 but didn't pay immediately, receiving an invoice instead. The journal entry is debit inventory $70, credit accounts payable $70. Every transaction impacts at least two accounts, and the total debits always equal the total credits. Now for the second half of DC, ADELER, focusing on the E for equity, also known as shareholders' capital, the amount owed to shareholders. Revenue, the main driver of income, has a normal credit balance since earning revenue increases equity, benefiting shareholders. However, to generate revenue, companies incur expenses like cost of goods sold and operating expenses. The normal balance for expenses is a debit since incurring expenses reduces equity, impacting shareholders negatively. Shareholders focus on the difference between revenue and expenses. If revenues exceed expenses, the company earns a profit, increasing equity. If revenues are less than expenses, the company incurs a loss, decreasing equity. Profitable companies may distribute dividends to shareholders, which also reduces equity. Since equity's normal balance is a credit, dividends, recorded as a debit, decrease it. ADELER, debits and credits. That is the underlying concept of T accounts and debit and credit in accounting. We hope you understand the concept better by now. Subscribe for more accounting knowledge with Invent ERP.